Hi, I'm Austin Gehring with Ag360 Grain Marketing. In this week's podcast, we look at recent price ranges, current fundamental situations, and some market outlooks. Numbers in today's report are based on the close yesterday, but should apply the same this morning. Today is the morning of Friday, May 30, 2025. Here's today's Market IQ report. Well, today we got a current price range for December corn near the lows, only 5 cents from the lows for the last 2 weeks and month and the last 3 months. The range for the last couple weeks and month is pretty narrow in the last 3 months. Also kind of narrow, but we did see a little bit higher prices over the last 2 to 3 months. Moving on to November soybeans, the price range for the last 2 weeks were near the low, but it's been a tight price range. Over the last month, we're much more in the middle of the price range. Over the last 3 months, we are still near highs, but the last couple days we did trade a little bit lower. And looking at July Kansas City wheat, the price range over the last 2 weeks and month, we're actually near recent high closes, as we've seen good support around 525 this week. Over the last 3 months, we are still on the lower half of the range, as we did see highs near 619 as a close over the last 3 months. Quickly looking at Kansas insurance prices, we've got the 2025 corn projected insurance price at 470, 2025 soybean price projected price 1054, and the 2025 wheat projected insurance price at 590. We will see the harvest price for wheat discovering here in June for insurance. Reminder, using crop insurance as your marketing floor can be a powerful tool in creating a marketing plan, and we will talk more about that in the coming slides. First, we'll dive into corn, see how the market is comparing today versus similar past situations. The short and long-term technical indicators gauges are 0 and 28%, meaning that we're on the weaker end of the recent price range compared with technicals. Looking at the U.S. carryout to use ratio, we're at 70%, meaning 70% of prices were lower than this with a similar situation in past. World carryout at 0%, meaning we've only seen higher prices with a similar world carryout to use ratio. The dollar index inflation still in the green, showing that that's still some pressure on the market compared to past years where the dollar index inflation has been, leaving the summary gauge at 0%, but it is kind of struggling a little bit as we're trying to put it all together into one gauge, not necessarily looking at each gauge individually, but trying to look at all the current fundamental technical situations and comparing this as one to past years. So more specifically, the summary gauge looks for similar U.S. and world carryouts and dollar index and inflation all combined, and find fast report days that had all of those similar at once. Bottom line, limited comparable combined situations. It would only take a small move higher, like 25 cents or a little bit more now, to get the summary gauge in the green. Be ready to take action during rallies. Moving on to market alerts for corn. Market alerts are first of two market IQ tools that can be used to create a marketing plan around. Reminder, these are sent whether or not the current price is above or below the crop insurance price, and try to alert you when there's a pricing opportunity. Old crop targets are for your remaining total production after harvest. New crop market alerts are for your target pre-harvest sales. Corn sent out 5 of 20 so far in this 2025 crop, and we'll at the end of the corn section we'll kind of talk about whether we'd like to do a few more or what's upcoming. Here's a look at recent market alerts so far this year. Corn has continued its kind of downtrend. We missed the most recent high, but we have not yet taken out the lows from May. Now we'll look at price targets, the second market IQ tool that a marketing plan can be created around. Price targets are not predictions, just an action plan if reached. As we mentioned, the crop insurance price established at 470. We have 5 targets higher. 3 of them have adjusted to 30 cents above the insurance price based on weighing risk and reward and historical research. $5 may be attainable for December corn with the right risks entering the market. We're currently 30 cents below insurance and 60 cents below the first targets. I think these targets at $5 are perfect. They're enough above the insurance price to be worthwhile, but not too far out of reach, and similar to highs we saw last year, as we can see early on in this graph. You can use this as a marketing plan if you'd like to only improve on the projected insurance price with your insured bushels, which again are your APH times your coverage level, and then multiplied by your number of acres. Just a reminder that past performance is not indicative of future results. This is today's price versus relatable report day prices. Today's price is the blue line. The yellow dots and lines are relatable report day prices over the last 10 years. The red, yellow, and blue coloring in the background help tell you how many times we saw prices at that price range. Red is often, yellow is somewhat frequent, and blue is less frequent. The current U.S. carryout to use ratio is roughly in the middle of what we've seen over the last 10 years. World carryout to use appears to be the lowest over the last 10 years. Just briefly glancing at each chart, the most common range for corn seems to be between $3.50 and $5. Though occurrences are limited, so I've been saying this for a while now. I'll take this one with a grain of salt. And so here's where we're at with the corn market outlook. Market alerts, we're currently 5 of 20. Price targets, we've currently sold 0% if you're following that plan, as we haven't hit any of those yet. But we haven't traded above the insurance price yet. So where would we like to be at this point? For market alerts, we would like to have sold a couple more, especially at the recent highs or peaks in the market. But we think maybe there's some opportunity yet. No price target, as we haven't traded above the insurance price. So according to doing that, we don't like trading below the insurance price for that marketing plan. Based on what we discussed in our current market bias, what do we see coming up? Well, we see slightly higher. I expect a few pricing opportunities, but we may not suppress the January and February highs unless major weather issues arise. I look to take action if we can go roughly 25% or 25 cents higher in the market. Some action, and we will see what types of sales we see at that point. Moving on to soybeans, the technical indicators are reading 49 and 64%, meaning we're fairly balanced in the recent price range about how weak or strong the market is. Looking at the U.S. and world carryout to use ratios, U.S. shows only 5% of bean prices were lower in similar report days in the past, but the world says 68% of prices were lower with a similar carryout to use ratio. Dollar index still heavy on the market, and the summary gauge showing 25%, but that one's a tough read. As this is a common world carryout to use ratio, but the U.S. carryout to use ratio is a lot less common and only seen during the height of the Russia-Ukraine war prices and a few other times previously. With the uncommon U.S. ratio, it might be quite hard to get that summary gauge in the green, so we might take some alternatives this crop season as we get moving forward. Also a reminder that the current carryout to use ratios are quite projections and not actual numbers. As we go through the season, we'll learn more and more about them, and they'll get hopefully a little bit more accurate. Soybeans have sold 9 of 20 market alerts so far this year. We sent out a few in early April. We'll talk about this in the market outlook slide, but maybe we should have sent out a couple more lately. Here's a look at the recent ones so far. Prices have been somewhat holding, though dipping a little bit lower this week. And we may see more market alerts soon. We thought maybe we'd have a chance to visit January and February highs, dipping a little lower. So if we can get back to May highs, maybe that's a good opportunity for more market alerts, even though those gauges are struggling a bit. Looking at price target for soybeans, crop insurance price is $10.54. We haven't reached our targets yet, as with corn, and we've adjusted 3 of them to 20 cents above the insurance price based on research. That's at $10.74, and we're currently 20 or 30 cents as of this morning below the insurance price and 50 cents below those first targets. Not completely out of reach yet with a weather scare. Moving on to historical soybean fundamentals and where prices have been, we have a lot more occurrences than we saw in corn. The most often traded range is maybe 850 to 1075, with the most likely occurrences maybe between 875 and 1025, it looks like. The U.S. carryout to use ratio is a little below the average of what we've seen in the last 10 years. World carryout to use ratio appears to be a little above the average of the last 10 years. This is where you can really see how confidence gauges are struggling to get a read on the market, as a lot of the higher prices on this graph were during the Russia-Ukraine conflict when we had a similar U.S. ratio. The world carryout to use is comparable to past years where you see the lower prices on this graph. We probably a little bit more downside than upside as we're seeing this week, but acres and weather can really be the main drivers this summer. Still kind of seeing where those acres are going to shake out. So looking at the soybean market outlook, kind of where we're at is the 9 of 20 market alerts we've sent so far, and price targets haven't been hit. Currently at 0%, as we've only recently just traded a hint above the insurance price. Where would we like to be? Maybe a couple more market alerts here in the last week or two. Seems like those were still pretty solid prices. No price targets yet, as we said, since we haven't traded much above the insurance price. The goal is to get at least 20 cents above, and then there's some price targets higher if we get there. Based on what we discussed in our market bias, what do we see coming up? Well, we're not trusting those confidence gauges as much. Might be a little bit more quick at selling rallies than I would be at corn. Look to make high sales at recent highs, even highs we saw earlier in the week or last week. Moving on to Kansas City wheat, short-term and long-term technical indicators are a little bit weaker. The gauge is showing 42 and 8%, meaning we're still on a little bit of oversold territory for long-term at least. That could add a little bit of support to the market, but looking at that U.S. carryout to use ratio, showing 93% of prices have been lower with similar U.S. fundamental situations. The world carryout to use ratio showing only 29% have been lower, so we'll start paying attention to that maybe again a little bit after harvest. Might be more of a U.S. trading June here with the harvest coming up. In the dollar index and inflation gauge, not quite in the green, still on the upper half of prices with a similar situation. Summary gauge back in the green. If we get a stronger close again today, we might look to send out some more market alerts, which we'll talk about in the next slide, which we'll talk about right now. We've sent out 17 of 20 market alerts so far this year for this 2025 wheat crop. Looking at the most recent one at 538 on the close. The previous day we did get up to 547 or so on that day. Hopefully somewhere in that range we can get back to again. We did make a higher low here a couple days ago. And we'll see if we get more opportunity to close out these market alerts before harvest. And as always, there will be market alerts coming up after harvest as well, though Market IQ tries to get them sold quickly, as some guys like to get them out of storage quickly. A lot of guys have elevator storage to worry about. So we'll see if we're able to break above 550 here in the near term. Here's the price targets for 2025 wheat. We won't hit the rest of the targets. Maybe we should have sold some more when the targets were hit. Tough to just use hindsight for that. For Central Kansas, we'll have to sell the rest of the insured bushels at the June average to ensure you receive your guaranteed revenue. For Central Kansas, probably not many losses this year, so your revenue will all come from sales and no insurance payments. If you have more to sell than your insured bushels, that's great. That is extra revenue on top of your guaranteed revenue. Looking at this slide at today's price versus reliable report day prices. Today's price is the blue line. The yellow dots and lines are reliable report day prices over the last 10 years. We know all this. The U.S. carryout to use ratio is at the higher end of what we've seen in the last 10 years. The world carryout to use is pretty average. Just looking at the chart, from 425 to 525 is the most likely average. We have seen some prices from 525 to 625. So we're just above that most likely range, and we're kind of below the medium frequency of prices. And we'll see where we go from here. Harvest pressure is going to keep this market probably here a little bit lower, but hopefully $5 can be a strong support level this time around. Here's where we're at for Kansas City wheats market outlook. Currently, we've had 17 of 20 market alerts. Price targets, we sold a total of 20%, which we could have sold more as there were some prices above insurance. But we didn't know, as we progress through the year, if there would be more and better opportunities. Where would we like to be at this point? Obviously, 100% sold, definitely on the market alert side. The price targets were hit early, as we mentioned, should have done more. Based on what we've discussed in our market bias, what do we see coming up? 550 on July futures is first resistance. 575-ish is the second resistance. Let's see what we can accomplish in the next 10 days before harvest pressure likely hits. $5 to $5.25 seems to have found some export demand. It may be solid support as we enter June. Quickly looking at cattle indicators, we're 2 out of 3 for both live and feeders. Cattle's retreated lately, but rebounded yesterday and again this morning. I keep reiterating that this is a bull market. It's tough to handle. They're still good at notifying when we're back at recent highs. Looking at hogs, we're back to 2 out of 3 indicators, but RSI at 63, getting to be stronger again. And U.S. diesel trading about 50 on the RSI, meaning we're pretty lukewarm. I think we were lower this morning. And that's a good job of picking out lows and potentially cheaper diesel prices. And then lastly, quick rundown of what our recent bids have been for corn, soybeans, and wheat. July corn, as of yesterday, was an 8 under, picked up your farm. July soybeans, 27 over delivered Wichita, and July wheat, 13 under delivered McPherson. Just a reminder, prices vary by location and are subject to change. And that's all we have for today. I want to thank you for listening. Be sure to find us on our website or on social media. We often have a daily grain market update video posted on our socials. Contact us for any questions about anything we mentioned today, or if you're interested in any of our services. We will see you next week.